Hi everybody, it's Woody. I have part 2 of this Woody's Goodies. What have we been discussing? We have been discussing the new required minimum distribution rules. We've been discussing in part 1 whether or not it makes sense to convert an IRA, a SEP IRA, a simple IRA, your 401k, a pension and profit sharing plan, non-deductible IRAs into an IRA. Does it make sense? We talked about in part 1 that you will take a tax hit, but listen, is this stuff important? And now, by the way, specifically what we're going to discuss are the exceptions. The exceptions to the 10% early distribution penalty. So, can you take an early distribution from your retirement plans? And if so, what is the impact? And do you meet one of these exceptions? Why is all this important? Because the amount, timing, and manner by which you fund an IRA and take distributions from these qualified retirement plan contributions, IRAs, and the manner and timing by how you plan those out, which years you're going to take these distributions from such plans, can make all of the difference between retiring securely and confidently versus not being able to retire timely, retiring in despair. You need to understand these rules. They're critical. So watch part 1, and here, of course, is part 2. So, certain exceptions to the 10% early distribution penalty apply specifically to IRAs, others to employer-sponsored plans, and some to both. Here's a general breakdown, and we will help you determine whether or not you should take an early distribution. And by the way, inside of a Roth, oh man, you have so much flexibility to take distributions, even right away in some cases. So should we do that for you? Come in, let us analyze it. Woody at cpaforwealth.com. Okay, exceptions that apply to both IRAs and employer plans. And these are the exceptions to the 10% early distribution penalty. Death. So if the account holder dies, the beneficiaries can take distributions without penalty. How they take those, how much they take those, that's all part of an analysis we'll do for you. Number 2 is disability. The penalty, the 10% early distribution penalty, does not apply if the account holder becomes totally and permanently disabled. 3, annuity payments. The penalty does not apply to distributions that are part of a series of substantial, equal, periodic payments. A lot of people miss this one. You may be able to take distributions, even from your pre-tax accounts, way before you're age 59 and a half. If you set up a series of substantially equal periodic payments. Do you know how to do that? What tables do you look up? What in the world are substantial equal periodic payments? We'll tell you for you based on your facts and circumstances. All you got to do is come in, email me, Woody at cpaforwealth.com. Right there, says it. Email me. I want to introduce you to our team of CPAs and financial planners. We have a financial relationship with them, all disclosed in our video description here. Come in. This analysis is free. Okay. Another exception, medical expenses. Distributions made to pay for unreimbursed medical expenses that exceed a certain percentage of your adjusted gross income can be an exception to the 10% early distribution penalties. Now, here's some exceptions that only apply to IRAs. Higher education expenses. Isn't that awesome? Distributions used to pay for higher education expenses for you, your spouse, or your children or grandchildren from your IRA accounts. No 10% penalty. First-time home purchase up to $10,000 can be used towards a first-time home purchase with no 10% penalty. 3, health insurance premiums. The penalty does not apply if you've lost your job and are receiving unemployment benefits, and you use your IRA distributions, your pre-tax IRA accounts, if you use those distributions to pay for health insurance premiums. no 10% penalty. Exceptions now that apply only to employer-sponsored plans. Leaving a job. If you leave a job during or after the year you turn age 55 or 50 for certain public safety employees, you could take distribution from the employer's plan without penalty. 2, qualified domestic relations order. You're forced, in other words. So if you receive the distributions as the result of a divorce order, the penalty doesn't apply. 3, phased retirement. The penalty may not apply to certain distributions to federal public safety workers during a phased retirement. Now, you need to remember this. Even when a distribution is free from the early withdrawal penalty, it may still be subject to regular income tax. So it's always wise to consult with a tax or financial advisor. I'm telling you we'll do this for free for you, woody@cpaforwealth.com. Email me. We are both of those things. We are tax advisors and financial advisors. And you need to consult with them and let them build out a plan for you to look at this before making a decision about early distribution from retirement accounts. Very, very important. Okay? So, I really hope this helped. We talked about a lot in part 1 and part 2. What we talked about are, I'm gonna summarize all of this. What are the new required minimum distribution rules for IRAs and beneficiaries? Why does that even matter? Why do you just not want to go on autopilot and start taking distributions? Let us do a distribution plan for you, a retirement distribution plan for you. What types of accounts can you convert to a Roth? Should you convert? It's amazing that a Roth allows tax-free growth forever. That's amazing. So we need to look at that, right? And yeah, we'll do that for you. Which of the early distribution penalty exceptions apply to IRAs and which ones apply to employer plans? Because sometimes you need an early distribution. Do we have an exemption? I talked about those, but should you take money early? Or which accounts should you tap first? In fact, remember, you're going to be looking at your retirement accounts, your tax-free Roth accounts, your non-retirement accounts. And how do we build your retirement plan? Tapping into which one of those accounts first is critical. And then finally, can a 401k be rolled over to a simple IRA? And the answer to that one, which I haven't answered yet, is no. A 401k generally cannot be rolled over into a simple IRA. The Internal Revenue Service only allows a rollover from a simple IRA to a 401k, not the other way around. That's important to look at, and we get asked that question a lot. After a 2-year period from the date of the first deposit into the simple IRA, the funds can be rolled over into another type of retirement account, such as a traditional IRA, SEP IRA, or 401k. However, you cannot roll over funds from a 401k or other types of retirement accounts into that simple IRA. Lots of rules here. I want you to always consult with a financial advisor or a tax professional before making decisions about retirement account rollovers, converting to a Roth, etc., any of these things, to assure you understand the potential tax implications and, of course, any restrictions. Please consult with us for free for a personalized plan. That's really key. These new rules could have different impacts depending upon your personal circumstances. So I want you to look at it carefully, and I want you to understand it, and I want you to allow us to put together this plan for you for free. All you have to do is email me, woody@cpaforwealth.com. You can do these meetings, by the way, in person or virtually. No problem. We can set this meeting up for you on Zoom, woody@cpaforwealth.com. I hope this 2-part series, this 2-part Woody's Goodies on all about the amount, the timing, the manner by which your IRA contributions, qualified retirement plan contributions, and manner and timing by which you can take your distributions. How does it impact you? What are the new RMD rules? What type of accounts can be converted? Lots of information here. Thank you for tuning in. I'll see you on the next one. Bye, everybody.